Good morning, good evening, good afternoon, depending where you are on the planet, and welcome to the Wednesday, the 6th of April, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. We're going to go through our usual normal run through in here today. Take a look at the calendar, what we've had, what we're coming up. Take a look at the major fundamental macroeconomic geopolitical events that are shaping markets right now. Taking a look at the major news wires. And then we'll take a look at some charts, what's going on, impacting markets right here, right now. Okay, calendar the most important thing on the calendar is going to be critical today is the Fed minutes. Okay, so you've got to be watching out for that. Nothing particularly notable through this morning, through the Asian European session. In here, we do get Fed speaker Harker speaking later today. Now, given what Laynard said yesterday, it's going to be interesting to watch. So 9:30. Harker is speaking, and then we get the Fed meeting minutes. That's 9:30. That is Eastern time, and then we get the Fed minutes at 2 p.m. Eastern time. The Fed is going to be obviously critical going into today, so we're going to certainly be watching that, given what happened with Brainard yesterday. Let's talk about that. So 5 things to start your day. There's Brainard there over on the right. So so it's going to be. It was significant yesterday. So Fed fallout in here. Global bond meltdown intensified after Fed Reserve Governor Laura Brainard said the central bank will start balance sheet reduction as soon as next month. Okay, so today's Fed minutes could offer some details. So in here, look, money market traders bet on the sharpest Fed tightening in almost 3 decades, with pricing now suggesting 250 basis points of hikes in 2022. That's 10 hikes in 2022 or 10.25s, but now we're more likely going to be getting far more aggressive rate hikes in here. Funds say stock and credit markets are too calm ahead of faster than expected tightening. So that's going to be really watched today after Laura Brainard. Now remember, in here I'm going to just show you this sheet in here. So in here, unfortunately I can't share through this webinar, but ITC markets. Okay, if you Google ITC markets or just Google Hawk Dove cheat sheet. Okay, if you Google Hawk Dove cheat sheet, I'll just Google that anyway. Hawk Dove cheat sheet. Okay, these are good guys. I know these guys at ITC. They're similar to they run a kind of school service, and also so you see ITC Central Bank Hawk Dove cheat sheet. So if you just go there and Google that, you'll come to this sheet in here. Okay. And it's not only got the Fed Hawk Dove cheat sheet, so we've got the ECB and the Bank of England there. And if we click in here, what you'll see, it's really useful, because what it shows you in here is you see like Hawk scale. So this is going from the most dovish going down to the most hawkish. Okay, so whether they're more dovish at the top or more hawkish at the bottom in here, and you'll see that Brainard in here is a dove. Okay, second on the list after Kashkari. Okay, so a dove in here, so it's really significant here. If a dove says something dovish, kind of big deal, right? If a hawk says something, if Bullard down here, a hawk, says something quite hawkish, kind of big deal. But the important thing in here is we've got a dove saying something quite hawkish. Equally, if you get a hawk saying something quite dovish. So a dove, Brainard saying something relatively hawkish yesterday. That's why you got an even more aggressive move than maybe normal than if one of these guys down here, whether in George or Mester or somebody has said it. Okay. And also remember, a Brainard in here tells you if they're a voter at the moment. So that some of the members of the committee of the FOMC committee are non-voters, and they go in a rotation. So Brainard is a voter, so that's significant as well. So Brainard saying coming up with a more hawkish tone yesterday, and that sent bond markets going lower in price, higher in yield. So if we go and take a look in here, so I've got in here from investing.com their yield chart. So you don't really trade on off the yield chart, but I thought it'd be useful to look at the yield. Look at the yield spiking high. So we've gone to new higher yields yesterday, spiked, really big move from like 2.40 on this is the 10-year, okay, 10-year bond yield. Went from 2.4 up to like 2.55, broke above the yield highs that we set in here at the end of March. And then even this morning, even more aggressive. So we're up to like 2.55 yesterday, and now we're up to 2.63. So another 8 basis points higher in yield. And if I just zoom out a little bit in here, go to a monthly chart, look, where the highest yield in here since back here. So this is February, March, like 2019. Okay, and closing in on 3%, and maybe even up to these peaks in here around 3.25. So a really significant move higher in yield so far this week. Okay, and that's across the yield curve as well. So we go in here and we take a look at, say, even the 2-year yield. I'll show more of the technical chart in here. Once it loads, so we've got the 2-year yield loading in here, and I'll switch it to a candle chart. So you can see a significant move higher in yields yesterday again. That we didn't even get a pullback here previously. So going higher and higher and higher and higher, and then gapping higher again in this morning, but coming a little bit of a setback in here on the 2-year. And again, if we go to a bigger chart in here, like going out to a month, look, we're much closer to the peak in here. This peak in here from 2018, really honing in on that peak. That peaks around just under 3%, 297. Okay, so racing up towards the 3% level on the 2-year yield as well. So yeah, significant high yield moves. That was really the story of the day yesterday. A more hawkish tone from Brainard, who's a dove, saying about, commenting on the balance sheet reduction as soon as next month, and that's seeing bonds sell off aggressively, higher yield pressures, then also sending stocks lower. Okay. The other thing, though, stocks were already looking a little wobbly in here, as because of the well, I'm going to say alleged murder. Yeah, it does say alleged murder of civilians by Russia in here. For the Western allies in here currently stepping up measures in here, the sanctions against Russia, and obviously that's a negative for like kind of global growth and for the global economy. So more sanctions potentially, and more stringent. The current sanctions being implemented more stringent. So also on the table are EU sanctions on Oleg Deripaska, an aluminium tycoon in here, and then maybe restrictions on Russian oil and gas. Okay, will have to be discussed sooner or later. European gas fluctuates as supply risk counters weather outlook. So yeah, two negatives in here: the sanctions plus the more hawkish tone from the Fed in here. Saw stocks go lower yesterday. The European stocks are even lower this morning, and futures, US futures, lower again in here this morning as well. So we go and take a look at that. We'll see in here European indices, red, sea of red in here, over 1% down across the board, up to like 1.5% in some places for the major European equity indices. And if we take a look at the US stock indices in here, we were down, the S&P down 1.25%, NASDAQ, I think, nearly down 2% yesterday. And the futures in here down another 0.5% in here this morning. Okay. NASDAQ's down over 1% in here this morning as well. Again, further lower in here this morning. So real negatives in here on the stocks, coming through from those more hawkish comments that came and then fed into the bond market, and then translated out into the equity market as well. So all very negative in here. And then a load of headlines on that. I'm not going to go through all this in detail, but same thing. So this is quite a bit. I found this quite interesting as well on Bloomberg. Global bonds slumped to a discount for the first time since 2008. So this is Bloomberg's global aggregate index of bonds. Okay, so it's gone below this kind of 100 level, a key 100 level, for the first time in here, as it says there, since 2008. So showing the aggressive sell-off in bonds. It's not just the US; these are global bonds in here. Investors fleeing the global bond market in here. You can see the surrender in here from 2001. Aggressive sell-off. In 2002, an aggressive sell-off in here, and breaking that kind of psychological, almost par 100 value level in here for the first time since 2008. And then say a load of similar articles in here. Look, bonds and US futures sink as rate hikes ramp up. Okay, so a more aggressive tone expected here. Global bond sell-off deepens as Fed steps up. Tightening rhetoric in here. So all eyes on the minutes, right? Fed minutes are real long-awaited deals of balance sheet pound. We're going to get some more information. If it almost feels like Brainard was preparing us for these minutes in here, and a half-point interest rate could have also been discussed. And we've been watching this, right? So this is not actually moved up that much in here, but it's nevertheless higher. We're now got over 75%, nudging now towards 80% for a 50 basis point hike now at the May meeting. And if we look by the end of the year, the market's now pricing in a lot more aggressive rate hikes in here. So we're potentially up to for Fed funds to be up 325 to 3.25, 3.5% in here by the end of the year. I mean, that's the outlier, but hot favorite in here for it to be up 250 basis points in here now. So by year end, okay, so that's significantly higher. Current target rates obviously only, so that's going to be 10 Fed rate hikes, maybe even more, or 10 25s, but it's more likely to be, there's more half points going in there now. As I say, we're already pricing in a half point in here, and then potentially going out into the June, starting to price in another half point going out to June. So a far more aggressive tone being reflected across the futures curve in here. So let me just go back to a few of these articles though. So Fed minutes are going to be important again in here. That's all from Bloomberg. Reuters, minutes of Fed March meetings seen, detailing a speedy balance sheet rundown in here. And then again in here, stock slip, bonds hit as bets on Fed action rise. And then again, another one here, morning bid bond bears get their claws out. So a load of articles in here on Bloomberg and Reuters, all focusing on the Dove, Brainard in here, okay, on Tuesday. Two normally dovish Fed officials, Lyle Brainard and Mary Daly, precipitated a fresh Treasury sell-off, which suggests the runoff might commence next month alongside a rate hike. So this is talking about the balance sheet reduction potentially starting next month. And then again, worries over US rate hikes, sanctions weigh on European shares. So a load of articles there. Oil as well in here. Oil fluctuates as EU avoids immediate sanctions on Russian crude. So no sanctions at the moment on Russian crude. Okay, EU will not target countries' flow over Ukraine war for now. Okay, so a little bit of a respite in there. So that would have obviously sent oil significantly higher. Let's take a look at some of the charts in here then. So here's the bonds. We already looked at the yield chart. Here's the bond future in here. So yesterday just breaking below the late March low and then significantly lower in here again. So very negative. And if we zoom in even on that and go to like, I don't know, like 15, 30-minute chart, market's just sat there. We've only just made a new low like an hour ago. We are seeing a little bit of rebound, trying to put a basing pan in, but you're not holding out much hope for that in here right now. Let's take a look at the damage done to the equity indices. So notable sell-off yesterday, but we're still holding above the low from the end of last week, from the 1st of April. But then this morning, look, down through that low. So now you've got lower low, lower high in here and a new lower low. That's a real worry in here. We spoke about, look, we've been holding the 23.6% retracement of the up move in here from the middle of March. We're now down through that this morning. So a real negative statement. And remember, this is in the pre-market. Okay, so it's even more significant that, there's no real new information since yesterday. This is all follow through. And the fact that the market's following through, breaking down through notable support factors after a big down day yesterday during the pre-market, effectively, before, US hours, that's a real negative signal in here for bonds for the stock indices. So I do think there's still risk further to the downside in here. If you go again into the 15 minutes, look in here, look, the market just seemed kind of free fall in here. It was not even trying to rebound in here. Big sell-off in here overnight, and then continued right the way through this morning. This is on a 15-minute chart. So negative pressures fully intact there. That's on the S&P, and the same thing on the Nasdaq. Look, so lower low and lower highs now. Second lower low goes in. The market down through that 23.6. 38.2% retracement. That's down at 14,374. Potential target down there for today. So all looking very negative in here for me at the moment. All pointing lower for a more aggressive sell-off potentially today. And again, if I step in, this is even on a 5-minute chart on the Nasdaq. Look, no rebounds, hardly any rebounds in here. Just like, every now and then a 5-10-minute rebound and then lower again. 5-10-minute rebound, lower again, and trying to rebound now. But market kind of in a bit of a free fall this morning. And again, pre-hours. Now, I wouldn't be equally surprised. I think you have to a little bit play this by ear on the open, and then obviously we got the open, and then not long after the open, you've got the Fed. The Fed minutes. So I think, there is an element of here. Don't be too rushed to sell in here. I mean, I think we will go lower, but this could easily turn. This could turn, 30 minutes into the cash market open. I'm kind of bearish right here, right now. And I think you have to go with the trend. But until you get a signal of a more bullish signal in here, you're kind of half getting it now. But, I'm not buying much into this. But I think it's going to be interesting on the cash market open. There could be value buyers coming in, right? These markets are down significantly from the peak already now. Okay, we're down what from the peak? I don't know, 46.26. we're down 44, so we're down like 4 or 5% or something down off the highs in here now. So it's a significant drop already. So you could easily see that I think the market in here swing back higher in here, some value buyers coming in, but probably after early weakness. Let the flush out come maybe on the open, and here we could see a rebound. So I'm not kind of holding completely onto the bearish tone in here going into today. I think you have to be a little bit flexible. Be ready for this market to turn around and rebound. Okay, so just watching out for that. Let's have a quick dip into the commodity markets. Take a look at oil and gold. Let's start off with oil. So look, kind of been choppy and sideways. Not much price action given what's going on elsewhere. You know, slightly higher with the threat. You know, some threat of sanctions, but at the moment, nothing really going on to oil, but slightly higher on the oil side. And remember, this is, you know, primarily driven by Ukraine at the moment, but also worries about the slowdown. So kind of you've got mixed kind of signals. Potential sanctions are obviously higher oil price, but if we get a big global slowdown, it's going to be negative as you get less demand. So market at the moment, inside day, is kind of a cautious session yesterday, slightly lower. If we zoom in onto a 30-minute chart, what does that look like? So look, if I look in here at a 30-minute, I've got no real strong view. I'm going to get rid of all this old analysis. But no massively strong view in here. You know, since this sell-off here, the market's been choppy and sideways. You know, you'd have to say slightly positive on the run-in up here. And then I would also be looking at this kind of, this line that comes across here. So we've got this consolidation phase. So you've got this consolidation in here. Oh, where are we? Kind of got this triangle now going on, really, since we had the initial sell-off down here. Market more in a range consolidation. So I've got no strong view in here. I mean, you know, hold a gun to my head. I'm slightly bullish. Probably want to wait now for a break above this trend line, which is going to come in around 104 and a quarter, 104.25. Maybe a break above there gives you your next trigger higher. You can probably sell against that if you want for a recoil back into the range with a stop and reverse above that. So no strong view there. Let's take a look at gold. And again, look, completely paralyzed. No view in here. I mean, on the daily chart, and if I go into the 30-minute chart, again, look, again, we're talking about, you know, we said this yesterday, right? You're going to sell it between 1940 and 1942, 1945 kind of area. I'm probably going to be trying to buy it 1924 to 1919. So at the moment, given we're dipping into that range, you're probably a buyer here, looking for a move back into here, and maybe a stop down below like 1915. Buyer here, stop below 1915, looking for it back to be back at 1940. So no strong view in here. Consolidation's always, for me, very difficult to trade. I know some people find them easier to trade, but for me, it's more difficult. Because, you know, where do you put your stop in here? Do you put it just below this low? Do you put it above the low in here? Do you have it? How far deep does the stop go? So that's tricky. How much you're going to get out of it? It might just pop back into here. So risk reward doesn't always add up with these consolidation trades. But we are at the bottom end of the range. So for me, it's probably a buy opportunity right in here, right now. So this is on a 30. If I dip into like a 5, yeah, we're getting a little bit of a turn. So probably right now is the time to buy gold. If you're going to buy it, if you want to buy it, probably now, as it tries to get this little turn coming from the bottom of this kind of multi-week range in here now. So yeah, slightly bullish, but yeah, only if you force me to trade that one. Okay, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe out there, and I'll be back with you with another bull versus bear webinar after and tomorrow. Be wary of those Fed minutes, and we'll pick the bones out of those Fed minutes tomorrow. Take care.